Good morning and welcome. It's a Friday morning. To remind you, last day of the trading week. We are at a point in the markets where we have now factored in the Fed rate hike. Markets have completely factored that in. And today, of course, is the last trading day of the week. We had US markets slightly higher. Ankita is going to take us through all the global markets, and this is a show where we take you through all the global markets news as well as domestic news and the stocks to watch out for. So stay tuned through the show 7 to 8 a.m. I'm Harsh Saita, and with me is Ankita Saxena. Let's quickly take you through the global markets. Ankita, talk to us. US markets funnily slightly in the positive.
Right. Good morning to you, Harsh, and good morning to everyone. Harsh, I think it seems that, as you mentioned, that the 25 bips rate hike is already factored in, but I think it's more of the commentary that's really, affecting the markets. Just yesterday, Janet Yellen said that the Treasury is ready to take additional actions if warranted to stabilize banks, and this comes a day after Yellen said that the blanket issuance of bank deposits, it's not being discussed. And despite that reassurance coming in yesterday from Yellen, Dow Jones was near flat, up 0.2% or 75 points, ended the day in the green. The S&P 500 was up 0.3%. The Nasdaq Composite was up 1% in trade as the technology shares continued to rally on a hunch that perhaps the interest rate hikes would be coming to an end. Now, all the three major indices are on track to close higher. Nasdaq has seen the biggest gain so far this week, up 1.4%. Both Dow and S&P 500 are poised for 0.8% advance this week. Now let's move on to the European markets. Now, European markets closed lower as UK's central bank announced its 25 basis points increase yesterday. It was largely factored in, but the European Stock 600 index closed down 0.2%. The banking sector led the losses throughout the day, eventually closing down 2.5%. DAX closed down largely flat in the red, was down 0.04%. FTSE was down 0.8%. CAC, however, was seen bucking the trend, was up 0.1% in trade. That was the global handover for Friday morning. Harsh, tell us, so where's the crude at?
Well, yes, crude has lost a bit of those gains that it made yesterday. We did speak about how crude made a good recovery on the back of a weak dollar. But that is pretty much wiped out. So we're seeing WTI below the $70 a barrel mark now. And we have Brent, which is at $75 a barrel, which was north of $76 a barrel. So that's a bit of a fall that we're seeing. Couple of reasons why, but the main reason being that the US reserves, which they generally keep, we had a testification at the Senate, which suggested that those reserves will not be refilled for quite some time going forward, and they're utilizing around 26 million barrels of those reserves, which saw therefore a continuous oversupply of oil in the global marketplace, which therefore brings oil prices down because supply is more than demand at the moment. So that's how crude prices are currently faring. Slightly under pressure is where crude is at, is how I would put it.
All right, Harsh, so crude under pressure, and let's take you through all the events that you need to keep an eye out for today. We have the manufacturing services composite PMI data that's likely to come out of US, UK and Eurozone. We will be keeping an eye out on that and bringing you all the information. Also back home, Manappuram Finance will be holding a board meeting to consider a borrowing program, and Imami will have a board meeting to consider a buyback. So these are the events for Friday. Harsh, take us through what are the global headlines that made news overnight?
Well, yes, as you very correctly mentioned, Janet Yellen in focus. The US Treasury Secretary continues to restore investor faith in the US banking system. She says that the federal emergency actions to back up cash-strapped banks like SVB and Signature Bank could be deployed again in future if required. The message comes amid flaring market concerns over small and mid-sized regional banks that are currently experiencing a surge of deposits in the wake of the SVB collapse.
And despite the global uncertainty and volatility, the Bank of England joined the Fed in hiking rates. UK's central bank raised benchmark interest rates to 4.25% from the earlier 4%. Now, it also went on to say that signs of inflation is still persisting and that could mean more hikes in the offing. Now, commenting on the recent banking turmoil, it said that the UK's banking system remains resilient.
Well, and central banks across the globe continue on their rate hike spree despite current volatility and uncertainty stemming from the banking turmoil in the United States. Following suit post the Fed and the BOE rate hike, the Swiss National Bank has hiked its policy rate by 50 basis points. This is the fourth consecutive hike and it's in line with what economists were expecting.
And shares of Jack Dorsey-led payments company Block plunged as much as 15% after Hindenburg held short positions in the company, alleging that company overstated its user accounts and understated its customer acquisition costs. Now, in its report, Hindenburg describes Block's internal systems as a Wild West approach to compliance.
Well, I will stick to Switzerland, and in the latest on Credit Suisse, the Swiss regulator has gone ahead in its decision to instruct Credit Suisse to write down its AT1 bonds. The regulator has instructed Credit Suisse to write down $17 billion worth of bonds. That's a large quantum, probably the largest ever write-off. The regulator said that that Credit Suisse received from the Swiss National Bank, the loan that it received last week was backed by the federal government and meant the conditions for a write-down had been met.
And on the latest development of the TikTok saga in the US, company CEO Shao Zichu was grilled by lawmakers from both parties on whether the Chinese-owned app can protest American privacy, as well as whether data from US users could end up in the hands of the Chinese government, which Chu repeatedly denied. He argued, saying that the platform was doing everything to ensure safety for its 150 million American users.
Well, and the Russian official Dmitry Medvedev warns that if Russian President Vladimir Putin gets arrested overseas, it would mean a declaration of war against Russia. The assertion by the Russian diplomat comes weeks after the International Criminal Court issued an arrest warrant against the Russian president over the alleged war crimes he committed in the midst of the ongoing Russia-Ukraine war.
And nationwide protests entered their 9th day in France. Police fired tear gas and fought with violent black-clad anarchists as hundreds of thousands of protesters marched against the President Macron's plan to raise the pension age. Though the demonstrations in central Paris was generally peaceful, groups of black bloc anarchists smashed shop windows, demolished street furniture. Clashes ensued as riot police drove back the anarchists with tear gas and stun grenades.
Well, and amidst the doom and gloom, there's finally some good news for those laid off. You can now apply and appear for job interviews on a tourist visa. What will this mean for non-immigrant workers? Take a look.
Now, the global tech and startup industry is witnessing a stream of layoffs. Tech giants like Google and Microsoft and Meta and Amazon, they've all laid off thousands of employees. And amidst all this gloom and doom, there's finally some good news coming in. The United States has announced that individuals traveling to the United States on a B1 or a B2 visa can now apply for new jobs and even appear for job interviews. They're often called the B visas. They're the most common types of visa that are issued by the United States. While the B1 visa is issued mainly for short-term business trips, the B2 visa is issued mainly for tourism. And now, in a series of tweets that we've been reading, the US Citizenship and Immigration Services, or like it's called the USCIS, says that when non-immigrant workers are laid off, they wrongly assume that they may have no option but to leave the country within 60 days. This move comes at a time when a large number of foreign-born workers, including Indians, have been laid off by tech giants and startups alike. Now, when a non-immigrant worker's employment is terminated, they get a 60-day grace period that starts a day after the termination happens. And during this grace period, a non-immigrant worker can take several actions to remain in the United States. These actions include filing an application for a change of non-immigrant status or an application for the adjustment of status, among others. But if no action is taken, the worker and his dependents are required to leave the United States within 60 days. So this decision by the USCIS comes a month after two Indian American organizations have launched an online petition urging President Biden to extend the grace period of H-1B visas from 2 months to a year. Meanwhile, in an interesting development, more than 1,400 employees at Google have written an open letter to Google CEO Sundar Pichai. That open letter has called for better treatment of staff during the layoff process. The employees have also listed a series of demands, and those include freezing new hiring, priority to laid off workers for job vacancies, and extra support to those at risk of losing their visa-linked residency along with their jobs.
Well, with that, it's time for us to slip into a short break. Don't go anywhere. We go domestic after this break. Welcome back. You're watching Market Cafe. Now, IT major Accenture came out with its quarterly numbers yesterday. Now, Accenture has lowered its annual revenue and profit forecasts, in its second quarter earnings. It also went on to add that it would cut about 2.5% of its workforce, or 19,000 jobs. The company has lowered the revenue growth forecast to 8 to 10%, which could be seen as an indication that there are worries of lower IT spends going ahead. Now, let's listen in to what the management had to say about Accenture.
New bookings were a record at $22.1 billion for the quarter, representing growth of 17% in local currency with an overall book-to-bill of 1.4. Consulting bookings were $10.7 billion with a book-to-bill of 1.3. Managed service bookings were also a record at $11.4 billion with a book-to-bill of 1.5. We were very pleased with the strength of our new bookings, which were broad-based, delivering a very strong book-to-bill across all of our geographic markets and across our services, with a book-to-bill of 1.5 in operations, 1.4 in technology, and 1.3 in strategy and consulting. Turning now to revenues. Revenues for the quarter were $15.8 billion, a 5% increase in U.S. dollars and 9% in local currency, and we're at the top end of our range, adjusting for a foreign exchange headwind of approximately 4% compared to the 5% provided last quarter.
We believe that the ongoing volatility and uncertainty in the macro environment is making it even clearer to clients that they need to change more, not less, and that 2 of the 5 key forces of change that we have identified for the next decade, the need for total enterprise reinvention and the ability to access, create, and unlock the potential of talent, are critical to succeed in the near, medium, and long term. We see 2 common themes. First, all strategies continue to lead to technology, particularly cloud, data, AI, and security. This is reflected in the latest market estimates, which are down slightly, but are still hovering around 5%. And second, companies remain focused on executing compressed transformations to achieve lower costs, stronger growth, more agility, and greater resilience faster.
Well, let's also listen to my colleague Anisha Jain as she gives her views with regard to the Accenture earnings.
Well, Accenture reported its Q2 performance, and it's not as bad as feared. Yes, it's on a weaker side when you look at the guidance cut, but that was pretty much expected by the street. Let me start with the Q2 performance, wherein the revenue growth has come in at 5%, and that compares with the estimates of 4%. Margins are a bit of a disappointment because the operating margin came in at 12.3%, and that compares with 13.7% that the company reported last year. And even on a full year basis, the margin guidance has been trimmed a tad bit. In fact, even for the revenue, the guidance now stands at 8 to 10% for the entire year, and that compares with 8 to 11% earlier. So 100 basis point is something that the street was already factoring in. In terms of the margins, as I talked about, there's a bigger cut because they are now expecting margins at 14.1 to 14.3%, and earlier the expectation was 15.3 to 15.5%. However, having said all of that, the positive this time in the earnings is the record order bookings. So order bookings are there to the tune of $22 billion, and the book to bill now stands at 1.4x, and this is much better than the 10-quarter low that we had seen in the earlier quarter. And the other thing to talk about is really the job cuts that the company has announced. While the street is, or rather was expecting a bit of a job cut, but the number of 19,000 is a bit concerning, because this means almost 2.5% of the total workforce would be laid off. Now, the company has maintained that this will be done over the course of next 18 months, and half of it will be in the non-billable business units, which means that it's not growth which is going to take a hit, but probably they're just doing it to reduce the cost and maintaining the operational efficiency. But this might be taken a tad bit negative by the street because the quantum is a tad bit larger as well. The utilizations were already high at 91%. For the headcount, they have said that between Q1 and Q2, the number was largely flat. And Q2 and Q3 will also see a bit of flat performance when it comes to headcount, and they'll only add headcount in strategic units come Q4. So a bit of a mixed bag coming in, but still not as bad as part of the street feared.
So, well, some more layoffs coming in the IT sector, Harsh. And with that, let's slip into a short break. We go stock specific on the other side.
Welcome back. You're watching Market Cafe on ET Now. Let me take it straight to Anisha, who's here to bring us all the stocks that are going to be in news today on the back of all the news flow that's come through since post-market yesterday. So Anisha, talk to us.
Hi, good morning. So defense stocks have been in focus for the last many trading sessions, and Bharat Electronics will be in focus in today's trading session as well, and that is because the Ministry of Defense has signed contracts with BEL as well as Indian Air Force. It has signed 2 contracts worth about 3,800 crore rupees with Bharat Electronics Limited, and this is for supply of medium power radar and digital radar warning receiver for Indian Air Force. So on the back of these order wins that have come in, we will have Bharat Electronics in focus in today's trading session. Apart from this, Vedanta will also be in focus. Remember, it was in focus in yesterday's trading session as well. We have some other news reports also that have come in, but apart from that, the board of directors have informed the exchanges that they will be meeting on the 28th of March to consider 5th interim dividend for the year. So on account of this, keep an eye out on Vedanta as well in today's trading session. Moving on to Rail Vikas Nigam Limited, that one will be in focus on account of an order win. The joint venture of the company with Messrs Rachna has received letter of award for upgradation of 6-lane highway project on EPC mode, which will be in the state of Gujarat. The cost of this project stands at about 252 odd crores, and company share in this joint venture stands at about 40 odd %. Imami will also be in focus, and that is because board of directors will be considering buyback today. Lastly, PNB Housing Finance, because board of directors meet is scheduled to happen on the 28th of March to consider rights issue. So on account of that, keep an eye out on PNB Housing Finance as well.
All right, thank you for those details, Shesha. We will be keeping an eye out on all the stocks that you mentioned. FII flows remain net positive in the first half of March, with commercial and professional services seeing the largest inflows. However, small outflows were seen in media. My colleague Somit gives us more details on that. Take it away, Somit.
Well, for the first half of March 2023, if you see, the FII flows were positive to the tune of close to $1.5 billion, and this was mainly on the back of the fact that GQG Partners had invested close to $1.87 billion in Adani Group stocks. Now, software and service sector saw the largest outflow of $458 million in the fortnight that we are talking about, and during this period, if you see, the Nifty IT index had declined by nearly 3% odd. In the last 1 week also, if you see, the sector has continued its downtrend and fallen another 3%, and this could be largely again on the back of the FII selling that we have been seeing. Now, energy sector also witnessed an outflow of close to $279 million after a small inflow that we had seen in the previous fortnight, and the sector has seen a significant outflows from FIIs in the last 6 months, and the total outflow in the last 6 months was to the tune of close to $2.3 billion, which is the highest in the last 6 months. Now, on the inflow side, if you see, commercial and professional service segment has seen the highest inflow for the second consecutive quarter. For the period, that is first half of March, if you see, the inflows were to the tune of close to $827 million US, and in the previous fortnight it was close to $261 million US. Utilities also saw a decent amount of inflows to the tune of close to $389 million US by FIIs ahead of the summer season. And despite this buying that we have been seeing, FIIs continue to remain underweight on the sector as compared to the MSCI index. Now, lastly, automobile and component sector saw the third largest inflow of close to 380 million, while Nifty Auto Index at that time continued to decline around 4%. And similar to utilities, if you see, FIIs continue to remain underweight even on this sector as compared to the MSCI index by around 1.2 percentage points.
Thanks so much for that, Somit. And Aisha held its management meet, and Motilal Oswal believes that the company is focused on profitability. Ashesha, take us through the key takeaways of that meet.
Yes, absolutely. So on the back of this meet, Motilal Oswal has come out with a note, and first up they're talking about demand. They're saying domestic demand continues to remain stable in the domestic market. They expect next phase of growth to come in from ramp up of Hunter in tier 2 and tier 3 cities, and as well as from other smaller cities. They also say that they are witnessing seasonal decline as far as export markets are concerned, thanks to the macroeconomic challenges that we are facing globally. However, they expect growth to be driven by ramp up in portfolio and its reach in international markets as well. New product pipeline continues to remain strong for Eicher Motors. The company plans to launch about 2 new models every year starting this year. They will continuously focus on growth, profit growth over absolute profit amount. They say Motilal Oswal believes that there are levers for margin improvement in the near term for Eicher Motors. Company, however, will continue to launch new products to address demand in the international market and to give upgrade options to RE owners in India as well. So strong commentary coming in from the management, and on the back of that we will have Eicher Motors in focus in today's trading session.
All right, another stock that is going to be in focus today is HAL, because HAL's offer for sale opened yesterday for non-retail investors. It was subscribed over 4 times on day 1. Now the OFS will open for retail investors today. Ashesha, you have all the details on this, so take us through all these details.
Absolutely, the stock will be in focus on second consecutive session, and that is on account of this OFS. Government intends to sell stake in the company. As you mentioned, it was open for non-retail shareholders yesterday, and it was oversubscribed. It was subscribed by nearly 4.51 times on day 1 for non-retail shareholders, and the company has also informed the exchanges that it will be exercising oversubscription option to the extent of 1.75% equity share capital of the company, in addition to the original 1.75% that was offered for sale, which means it will be for a total of 3.5% of the total equity share capital of the company. It will be open for retail shareholders today. It has been done at a floor price of about 2,450 rupees per share. Remember, on account of this OFS, which was open for non-retail shareholders yesterday, the stock has fallen nearly 5%, and the stock is off from its highs as well. It is down 78% since last year, and currently it is under FNO ban as well. Let's also understand the implications post this OFS is done. The company is a candidate for MSCI inclusion, and stake sale possibly could increase the free float in the market. MSCI inclusion cutoff prices have come down to 2,150 rupees per share from the earlier price of 2,650 rupees per share, and the expected inflow increases to about $195 million from the earlier figure of $155 million, and the public shareholding as a result of this OFS is also expected to go above the 25% mark. So keep an eye out on this stock. It will be open for retail shareholders today. Remember, yesterday also the stock was under pressure. It declined nearly 5% in yesterday's trading session.
Right, thanks for all of those details, Ashesha. HAL definitely in focus even today. But quickly moving on, we have Vamakshi with us, who's going to take us through all the brokerage notes that she's been going through. Vamakshi, what are the key takeaways?
Let's first start off with PB Fintech. We have a note that has come in from Morgan Stanley. They believe that the increase is driven by a strong fundamental performance, and if the fundamental performance seems to sustain, they also see a further scope for re-rating. So given all those factors, Morgan Stanley has actually maintained its overweight rating on PB Fintech, and in fact increased its target price from 705 per share to 810 per share. Hindalco is the next one on our radar. We have a note that has come in from JP Morgan, and they're highlighting highlighting that the near-term earnings for the company are expected to see an improvement. They're expecting the capex to be aligned with the cash flow, and in fact, on the back of lower LME prices, they've in fact cut the EPS estimates by nearly 8 to 10%. So overall, they maintain an overweight rating on Hindalco, a target price of 490 per share. The next one and the last one for us would be Tata Motors. We have JP Morgan coming out with a report, and they believe that JLR's retail outperformance is expected to continue on a low base. It has outperformed peers in Europe. As far as China is concerned, the performance has been largely in line with the peers. The sales mix remains strong, and in fact, the contribution that is coming in from China is steady. So given all these factors, JP Morgan has actually maintained a neutral rating on Tata Motors, target price of 415 per share.
All right, Mamakshi, thank you so much for that. We will be keeping an eye out on all those stocks that you mentioned. Now, moving on, tracking the latest on the mining major Vedanta then, sources say that the company has approached sovereign wealth funds and alternative asset managers from Gulf, the likes of Mubadala, ADQ and Bahrain's Investcorp and Saudi Arabia's Public Investment Fund. Now, with debt repayments ballooning to $2 billion set to mature by June this year, billionaire Anil Agarwal is mulling a strategic stake sale of up to 10% in the Indian unit. Now, side by side, the company is also exploring potential cash flow leveraging from the domestic subsidiary and transferring the said funds to the payment via the dividend payout route.
Right, thanks for that, Ankita. Let's quickly move on. Campus Activewear. Now, sources tell us that TPG, which holds around 7.5% in Campus Activewear, is set to or has offered to sell this 7.6% stake. JM Financial is the sole book runner for this particular deal. Now, it's the total size. Let me take you through some of those details. The total size of the deal is roughly 800 crores. So we have a floor price of 345 rupees a share, discount of around 6.8%. You can see some of those details on your screen. Now, the stock listed at, or rather the IPO price was around 290 bucks, after which the stock ran up quite substantially to 630 post listing, but it has come off 40+% post that, and now with this particular block deal on the cards as well, I have to wait and watch as to what the reaction will be. Of course, the source-based news, at least at the moment, but that's where we are. Campus Activewear will also be in focus.
All right, then Nilesh Shah, MD and CEO of Envision Capital, believes that the current global situation is not as bad as 2008, as he expects India to give returns in line with the peers this year. Listen in to his exclusive conversation with Nikunj Dalmia on various aspects of the current market situation.
So I don't think it's going to be worse than global markets. It probably could be that India would fall or correct or consolidate in line with global markets. And then after that, I think come the end of this year, the start of next year, 2024, you're going to see a huge outperformance coming in from India, because again, all the positives will come back, the world gets into a risk-on trade, and India is going to be the dark horse.
Okay, so let's divide the market in three time phases: 1 year, 3 year, 3 year plus. What looks good and attractive for 1 year, 3 year, and 5 years?
I think because from a 1 year perspective, the large caps look good.
Okay.
I clearly believe the
buy the Nifty.
Buy the Nifty, or buy a basket of maybe 5 to 6 stocks in the Nifty, you know, and I think they all have come off on an average by about 25%, 20 to 30% from their peaks. Maybe the room for them to fall further could be 5 to 10%, because you can never say where the bottom is. But I think from a 1 year perspective, I think that pack will do extremely well. Okay, so I think from a 1 year perspective, I think that's the space. From a 3 year plus perspective, I clearly believe that the mid caps and small caps will essentially are going to beat every asset class globally and in India hands down. Okay. So I clearly believe from a 3 year plus horizon, I think mid to small caps look really well poised for a big outperformance.
5 year plus?
Hard to say, but I think 5 year plus, I clearly believe that in a bull market or an upcycle, the mid and the small caps will outperform. And this has happened always. And so if you ask me from a 5 year plus, again, it's going to be largely mid and small caps, which will do extremely better. Now, you could, when I say mid and small caps, it could also mean a bunch of stocks which today are probably hated, are large enough, but you can't call them as mid and small caps because the capitalization is a bit higher. But for example, some of the stocks on the online side, which had IPO'd in 21, I think from 5 years from now, these could be hugely profitable companies and they could be a lot more valuable than where they are today. So it could be a set of stocks which are either hated today or are doing well but are still mid and small caps. So from a 5-year perspective, I think that's the pack which will do very well.
Right, so that's his view on the 1, 3 and 5 years. Nilesh Shah of Envision Capital. Let's quickly move on. Asian markets, let's see where they currently stand at. We saw US largely flat but marginally in the green, and we're seeing the Asian markets in the exact opposite direction. We're seeing the Nikkei, which is down around 0.1%. Slight cuts across the board. We're seeing the SX 200 as well as the Kospi is down 0.5%. Plus, we have the SX 200 also, which is down around 0.2% or thereabouts, 1/3% down, as you can see on your screen. The Hang Seng clinging on to some amount of gains, but absolutely flat as we speak. In fact, it's down 0.1%. And let's look at the Shanghai as well. Even that's pretty much in negative territory, down around 0.5% as we speak. So across the board, we have a negative. In fact, SGX Nifty also down around 0.1% as we speak.
Right. With that, we're completely out of time on this one. Don't go anywhere. The markets will take the action forward. Thank you so much for tuning in.